Welcome to the Market Huddle Plus, episode 36. I'm Patrick Serezna with our weekly 30-minute catch-up interviews with past guests. This week, we welcome back our good friend, Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, great to have you back on the show, bud.
Great to be here again with you, Patrick. I always love our conversations.
Yeah, well, I do too, and that's why you're back. And so the Yeah, you recently wrote an article. I really wanted to kind of pick your brain on this. It says your article is titled "So It Seems Like I Missed Something," and you discuss the unexpected volatility in global equity markets coinciding with your vacations. And I jokingly thought to myself, clearly we have the same vacation schedule because it seems like almost every time I go, something big happens anyway. But listen, could you elaborate on the key indicators that led you to conclude these market reactions and interpret these dynamics this way?
Well, sure. I think you're much better traveled than I am. So let me put that out there. Every time I talk to you, you're somewhere else. So I'm a little envious of that. Um, but I guess what happens was, I came into the month a little bit cautious. And my reasoning was it's a tape that's almost impossible to fight. At least it was, as the quarter ended. But as I sort of look forward, I'm like, could you really extrapolate that? Can you annualize that first quarter result, or even more so the past 5 months result, and just sort of say we're not going to move sideways as we get into earning season and as we get into the sell in May and go away period. Um, and so I did, put out a note. It's a tough, essentially, it's really, I wouldn't necessarily fight the momentum trade, but I would move defensive. I would look for hedges and things I would of that nature, and I'd move more toward value than growth and dividend paying stocks. And I didn't really expect it while I was away to just see the market having a few really rocky days. I was kind of looking for more sideways than down. Um, but I think what we saw was, number one, I think the crazy momentum that we saw into the end of the third quarter, I'm sorry, the end of the first quarter, um, was just that. It was just sort of let's all pile on, let's keep just jumping on top of the market and unrelenting. I'm sure there was a lot of portfolio window dressing on there. Um, so again, that part was a little bit normal. I think we ran into some hiccups because of U.S. tax season, quite frankly. If you were lucky enough to have traded in and out of Nvidia from the long side during 2023, or smart enough, you had some profits, probably some substantial ones, and that bill came due on April 15th. So it's no coincidence that some of these stocks started to run into trouble. Um, the midweek of before, because with T+2 you need to get the money in your account. So I think that sort of weighed on it a little bit, and I think when the momentum stopped, whoever was sort of manning the air pump took a little bit of a breather, and we got a bit of a pullback. But it's important to remember pullbacks are healthy and necessary. It's scarier when markets don't pull back. I think the idea that we had a 13 VIX was unsustainable. I think the idea that we were sort of outlawing volatility was unsustainable. And it's also important to remember that, okay, we pulled back, from an S&P terms, top to bottom, maybe, call it 5%. That's not even a correction. So, I think let's keep everything in focus here. That, the unrelenting advance um, was more unusual. The preponderance of greed over fear, the almost total preponderance of greed over fear, was a bit unusual. So I think, we went a ways toward restoring some of that balance, which I think is important in the longer term.
Well, inevitably, there was going to be a correction. It's just a natural byproduct of the markets, that the ebb and flow movement. And the bigger question is it a trend shift? Now, you talked about that trends stay in motion. And you have to assume in many cases that this will be the path of least resistance. But then you highlighted some of the things that could be external forces that could potentially be the headwinds for the markets moving forward. Obviously, one of them was we're going into the earnings season. What do you have any insights as to how the earnings have been coming in and what your thoughts are and how earnings are playing out here?
I think I think so far, look, we've got our standard 80% of the companies beat expectations, which, ought to tell you something about the expectations if 80% of the, if it's typical that 80% of stock companies beat their expectations. So I think people are more focused on guidance than they are on the actual numbers. I mean, obviously, you don't want to, if you're a company, you certainly don't want to miss your numbers. Um, but I think they're generally muddling in okay. As we're taping this, we really haven't seen a lot of the mega cap earnings come out. Tesla's literally hitting the tape as we speak, which I've in my personal Mag 7, I've got it down to a fantastic 4. So Tesla's not in there, but talk about that company sort of. My thesis coming into earnings was that you could get a contrarian bounce because everybody's looking for something horrible. So
Right.
when everybody's on one side of the boat, it often, goes toward the other. But I think people are going to be much more concerned about guidance, and I think people are going to want to see earnings broaden out. The problem is if you took away the S&P, it's more or less like the S&P 495 and 5. You've got all this growth priced in from Nvidia, Microsoft, Meta, Amazon, the usual suspects. Let's call them Alphabet, or
Yeah.
else I'll make it like a Fab Five or something. But it's very top heavy with the earnings growth coming from them. Energy is starting to give you earnings growth, but that's problematic in its own way because one of the first lessons I was taught in the business was be nervous if energy stocks are the ones leading the market. Because it means some inflationary pressures are kicking back in. So I would say the earnings season so far is better than feared, although there are some stocks that have been taken out to the woodshed for fairly minor misses and what I would call my earnings peccadillos. I think uh, I think people want. I think coming into this, people really, let's say prior to last week when we sold off a little bit, I think people were coming in needing to see not only companies, do the standard penny beat, but also up their guidance. I think when the guidance was a little lackluster, you saw them get punished a bit. Now I think maybe having, seen some of that work its way out of the market, I think we could sort of be a bit more even-handed as we go through earnings. But it's all subject to change when the big guys start coming out.
Oh, absolutely. And it'll be really interesting. Just to your point, at least the first reaction is Tesla rose higher after its earnings. And that just goes to show just how much how sentiment plays a role. Is that when everyone's loaded on the one side, often the market just reacts the other way just because it's so crowded of a trade. But yeah, we'll definitely see how the other Mag 7s come in. I think it's going to play an important role. How much do you think seasonality plays in? Obviously, you mentioned tax selling, but there's the typical sell in May, and usually summer is a challenging period just because volumes drop so much. Do you think that after such an extraordinary bull run at the start of the year, that we're going to start getting very heavy into the summer?
I think the possibility is there. I do think you kind of. I don't think we've finished consolidating the big up move that we had. I think that um, it's still so much of the move that we saw was predicated on valuation expansion, multiple expansion, the P going up faster than the E. Um, that I think you do need to sort of continue to move sideways and back and fill a little bit before you move on the next advance. From a U.S. stock point of view, of course, it's an election year. I hate to use the word unprecedented because so much about it is unprecedented. In
Yeah.
terms of the having one of the candidates showing up in court every day rather than the campaign trail is just bizarre. So I think you're going to get a lot of bizarro moves. Um, when it comes to the political aspect of it.
Right.
And so I think you know, and you can't escape the tax man. So I think that was sort of the initial catalyst.
Yeah.
And now we sort of move. I don't think seasonality's been repealed, but man, I don't think it's a coincidence that the rally started on November 1st. So
Right.
let's see what it peters out if it
So,
does.
so, in that article, you brought up the topic of portfolio insurance, using options as insurance on the downside. And I mean, you make the point here that it's never been really cheaper to insure your portfolio. Now, obviously, the VIX, which is a measure of shorter term insurance, like 30 days, had a spike. We saw the 20 handle on the VIX on the upside, but a lot of the longer, the implied volatilities on longer options didn't really react in the upside the same way. When you're talking about portfolio insurance, how do you approach it? Do you look at insurance as a short-term thing, like as in like, you want to insure the next 1 month, or do you approach portfolio insurance over a longer time frame? How do you look at it?
You know, it really I don't love buying options that are too far out. I don't like paying all that time premium. On the other hand, this I'm going to be the proverbial two-handed economist here, even though I'm not an economist. So it really depends on your nature and how much you feel you're comfortable hedging and rehedging. So I don't like to buy a lot of time premium. On the other hand, a lot of people would prefer to hedge using, let's call it end of year, 1 year, even longer options because you sort of have that insurance and you pay, and then you kind of forget about it. You don't have to be constantly monitoring it. So that's one advantage versus another. Um, I tend to be a little more short-term focused. But I don't. But that doesn't mean I'm talking about like zero-dated options or any of that. One of
Yeah.
my biggest pet peeves is when people were saying, "Oh, have zero-dated options replaced VIX?" And my argument is, of course not. You can't hedge with an ultra short-term option because the
Yeah.
one day you don't hedge, or the one day you have a little execution risk, is the day that it's going to blow up in your face, and you're unhedged. So that's why I tend to focus a bit more on your bigger index and ETF options. It's appropriate to hedge with either SPX or SPY or Qs. Um, it's appropriate to hedge with VIX. I mean, VIX calls tend to be a pretty good hedge. Again, one of my other pet peeves is that VIX is not strictly a fear gauge. I like to say it's not a fear gauge, but it plays one on TV. But it does reflect um, VIX goes up when things get rocky. It just does, because to me is the VIX to me, yes, officially it measures the market's best expectation for implied volatilities over the coming 30 days. Um, but what it really tells me is it's a measure of the demand by institutions to hedge, because
Right.
that's VIX complex is a very good way for them to implement hedges. And so when you see VIX rise, that means there's demand. Broadly speaking, it means there's more demand for hedging. When you see VIX fall or get mired in low levels, it means the demand for hedging ebbs.
Yeah.
One of the tells is looking at VIX futures, which I think are a very useful tool as well. Not necessarily the easiest product to use as a day-to-day hedge, but they're very useful as a tell, so to speak. And the reason is when you see VIX go into backwardation, that is the market's way of telling you that there's a real shortage of available volatility protection relative to the demand.
Right.
We really haven't come into those situations. They're pretty, and when we do, they're like really fleeting lately. Um, but that's important to know. Like the volatility is the commodity in question when you're trading VIX,
Yeah.
VIX futures, and contango versus backwardation tells you whether that any commodity is in plentiful supply or short supply. So those are some of the
Absolutely.
ways that I go about it.
The it's an important observation that for listeners to know that like the VIX normally trades in that contango, and there's almost always a roll cost moving forward. So when it turns into backwardation, where the short term ones are higher than on the VIX than the longer term ones, that's what Steve was referencing to. But Steve, the interesting observation I made from trading I spend a lot of time hedging with options. What I have found is that the VIX is very good for hedging the first impulse reactions to a market correction, and usually that first drop in the markets, the VIX captures that incredibly well. But when there's a sustained downtrend that is repetitive, and the VIX kind of goes to a new higher elevated level and stays there, it no longer tends to continue to add further hedges at those elevated levels. And that's the debate of using the SPYs or the SPXs versus the VIX. It's like the VIX gives you that first reaction payoff, which is perfect for if that's what you're looking for. But, if you're looking for a more sustained and measurable hedge that kind of, especially in sustained downtrends, that's where directly going to the indices I find works better for me. Um,
I,
I don't
I
know if you
don't
have an
disagree with
observation.
I don't disagree with that at all. VIX is you're right. VIX gets you that first step,
Yeah,
which is why when I get a little bit, I like uh, VIX vertical call spreads when things look either a little cheap or a little dicey,
yeah,
and because of that. But you're right. It's not a great sustained hedge. You're much better off using other more lasting type of hedges if you really want to hedge your portfolio. Um, on the other hand, to me, the most basic way to hedge your portfolio is at some level you may want to raise cash too.
yeah.
That's that's
Wow, that's a great.
right. I mean, again, I
Yeah,
think sometimes where people forget to do it is, there's you don't want to go in and out. You have your core
yeah,
holdings, and there's particularly depending on your tax status, you may not want to sell out of stuff where you have long-term gains and things of that nature,
right.
and turn them into short-term gains. I get it, but I do think this is when it is important to have a bit of asset allocation in terms of,
Yeah,
let's say, value versus growth, or um, if you can make those kind of shifts, you move a bit more, you move a bit away from high beta stocks to lower beta stocks. You move to stocks that pay solid dividends. And uh, my caveat here is those dividends have to be supported by cash flow, not a company
right,
that borrows to pay dividends. And
right,
those are ways to sort of insulate your portfolio too. But I think in terms of um, hedging using options as insurance, yeah, I think you want to figure out what is your. It's important not to overinsure, right? I mean, one of the basic things about insurance is, um, we don't really hope that our insurance pays off, right? I mean,
right.
you have collision insurance on a car. You really
You
kind
don't
of
want to
hope
crush.
that's wasted.
Yeah,
You're not going to crash your car. Actually, one of the weird things about options as insurance is, um, if you were to buy insurance on something, you have to have both an insurable interest and no moral hazard, meaning that I can't buy homeowners insurance on your house because it creates the moral hazard. I have no insurable interest on your house, and it therefore creates the moral hazard for me to, you know, if somebody would have been do something, vandalize your house, I'd win. So there's
Yeah.
so they really avoid that for obvious reasons. In options land, nobody knows or cares.
Right.
So yes, you can use options to speculate on the short side, which you can't do using insurance. But if you're trying to think of options as insurance, and oh, by the way, you don't have to have an insurable interest. I could just go out and buy puts on anything right now, and nobody cares. That's just a feature, not something that's avoided as you do with an insurance contract. But what it means is if you're approaching options as insurance, think about what your insurable interest is, the loss that you're willing to withstand. Your deductible is essentially your, you know, the cost of the cost of purchasing the insurance contract. I mean, it's not. I guess it's more just the premium that you pay for the options, but it's like think of it like an insurance payment, and you know, if you're how and think of how much you're willing to lose. I mean, if you're
Yeah.
if you need the money in the short term, you may want to hedge a lot more than someone who's willing to say, you know what, market goes down 10%, so be it. Or if
Yeah.
the market, I may want to hedge against a 10% drop, but maybe I'll offset that and write puts that have buy let's say 10% out of the money puts and sell 20% out of the money puts, because you know what, down 20% I'll buy the market. There's a
Perfect.
lot of
Yeah.
different ways to do it, and there is no right answer,
Well, it's in,
except to say that in the example I gave you, please only do it with cash secured. If you're writing puts, do them cash secured, because um, you know that I don't want anyone
or spread trades as
spread
a
trade.
way of that with definable risks. What I wanted to though just touch on your point that you just made there, because you were talking about potentially putting it on as a spread by selling, an option 20% below. I was going to ask you, like, when you're thinking about insurance like that, is it important to just be long gamma in a pure way and have an absolute definable downside risk payoff when you just have the put options outright? But obviously, your theta time decay and carry is much more expensive, or is it more practical in your mind to implement a lot of that insurance hedges with these types of spreads? Because when obviously the skew is in your favor on those farther out of the money options, often you can get a very good payoff on a debit spread on the downside of the market. Do you generally have a preference of which way you approach that?
How I approach it, I tend not to mind doing that. If it's a stock, or I don't mind owning, or if it's an index that I think I'm willing to buy it at such and such a price. But it takes a bit of discipline, because what happens is what ends up happening with a lot of people is, let's say you sell a 5% out of the money put and buy, I'm sorry, you buy the 5% out of the money put and sell the 10% out of the money put. And but it's certainly not uncommon for people to freak out then if it goes down 7%, right?
Right.
My short put is
You're
approaching.
going to run into trouble, right?
I'm going to run into trouble with that. Well, if I really don't mind, first of all, if it closes down 7%, under that situation, I'm thrilled, right?
Yeah.
Because I presumably made money on the 5% put, and
Yeah.
kept my premium on the 10%. But it gets sweaty, and again, that's where you either have to be you better be well capitalized and disciplined if you're going to do a trade like that, to try to hedge that sort of situation, because markets have a way of finding your weakness. And so that's where it becomes very important, to think in terms of, really, where is my discipline? Am I going to, if I'm going to freak out, if I get close to my short put, rather, I say I want to buy it down there, but I'm not really prepared to, that's where you get yourself into trouble,
Yeah.
because of that.
Well, I wanted to just touch on one more topic, because you were saying that you even wrote an article about it, the forgotten Greek row. So I wanted to talk about interest rates for a moment. There's an entire generation of traders that didn't even know row existed, because we had zero interest rates for a decade, and they had almost no impact on option pricing. It's just certainly not from a change during the period that you own it. And suddenly we're now in this inflationary period, much higher interest rates. a Fed that did a very aggressive interest rate hike, and suddenly now it becomes very clear to a whole generation of new traders how interest rates are impacting option pricing and generally makes the calls more expensive and puts cheaper. How do you view this? I mean, is that generally now advantageous, making the put insurance even that much more favorable because of that discount element?
Well, yes and no. If you want to insure a certain level, it does appear cheaper. And let me back up a bit because I think this is the part that people forget about. Is the when you're talking about at money on a longer term option, you're talking about the forward value. And the forward value is based upon interest rates. So if I were to, and it all ties back to synthetic futures. In theory, if I buy a call and sell a put on the same strike at a certain, of a certain month, I've actually, basically, created a synthetic future. And so there's an interest rate advantage to trading futures or even synthetic futures than there is to buying a stock outright. You forego the dividend if it pays one, but you also basically get to keep the extra the margin advantage, as it were. Futures trade with less margins than stocks do, so that excess, that increase in cash that you get to hold, you can invest at, right now, let's call it call it 5%, just to make the
Yeah.
numbers work. Um, and so what it means is, if you're if you look at an option that's about a year out, um, it's going to the at money value is really somewhat above where the underlying stock is. So, for argument's sake, if you have $100 stock and it doesn't pay a dividend, a 1 year option, the at money amount, quote unquote, on that 1 year option is about 105. I'm
Right.
really just,
At a 5%
I'm being
interest rate.
very general because that's the
Yeah.
interest rate. Now, it's sometimes difficult to figure out what that forward value is. And the long and the short, the shortcut to doing it is look and see where the put and the call are roughly equal. And
Yeah. The
that'll
put
tell
call
you where it
parity.
is. And you'll
Yeah.
see. So if it's $100 stock in the scenario I gave you, you would expect to see that probably on about a 105 strike.
Right.
It gets a little wonky if it's hard to borrow. And I gave that example when people were asking me what was going on when DJT was having its trouble, and it was saying I used the same thing. Look where the put price of the put and the call are about equal, and you'll see it was $5 below the stock price at its worst. Let's say, or $6 or $7, even on short-term options, because it was such an intense interest rate. But that's your way of doing it. So going back to your original question, if I want to hedge the $100 level using a 1 year option, technically it is a bit cheaper because technically it's out of the money, which is fine because you're not necessarily doing. I
Mm.
don't think most of the listeners are doing the arbitrage. They just want to say, I want to hedge this stock and make sure it doesn't go below $100.
Yes.
So that's where the sort of
Yeah.
that's where Roe benefits the put buyer. Um, you
In this
know,
cycle anyway, because
in
it
this
certainly
cycle,
wasn't, because it wasn't the case when interest rates were going up. Uh, uh,
exactly, the put was where it was working against you
yeah.
because the forward value was rising. In that scenario that I gave you, if rates were to go up to 10%, well, that would mean that the quote unquote at money price for a 1 year, for 1 year option would be 110. And so it's hurt if you have a 100 strike put, and the rates go up, well, you've moved further away from the at money amount, so to speak.
Right.
And vice versa for calls. And so you do have to pay attention. I think there were a lot of trades that were going on, using synthetic futures or puts and calls to play the expectations of lower rates. And I think as those rate expectations faded from the market, I think there were some longer term um, trades going on in relatively deep options trying to play that, or synthetics and things of that nature. But that's for most listeners, it's not really what you want to be doing. If you want to be trading interest rates, go trade fixed income.
There you
Seriously,
go. Well,
or go trade a
but
fixed income ETF or something of that nature.
generally, if a rate cut cycle is going to get underway, it is a tailwind for put buyers. But you shouldn't necessarily trade it that way, but it will be a tailwind to your put price.
All things being equal, yes. Now, so yes, just the row factor.
Yeah,
If we were to go back to zero interest rates, sure, that at money price would be 100. The forward value would decline, which would raise your the value of your put. Again, all
yeah,
things being equal.
yeah,
From an actual investing and trading point of view, I think it's more important to understand why those rate cuts might be occurring, which was sort of my conundrum at the beginning of the year, which was we were not going to get a solid economy and 6 or 7 rate cuts,
yeah.
right? I mean,
Agreed. Yeah,
now we've moved toward the solid economy, which is good. I'll always take the solid economy over the need for rate cuts, but you know, if the rate cuts are coming sort of as preventative medicine, then that's probably beneficial to stocks. If they're coming because, oh crap, we need 6 or 7 rate cuts, that's probably a problem. So there's plenty of moving parts,
yeah.
but it is important to keep row the effect of interest rates on options. It's in play because, as you noted, we could pretty much ignore forward values before. The only thing that really we worried about for forward values was dividends, and now it's like, oh
Right.
wait, interest rates are back.
Right, right. Well, listen, Steve, we're running low on time, but I can't let you go without actually touching on one more of your articles that you wrote, because you were talking about the monthly option expiration, and I've increasingly been pondering on these monthly OPEXs if they've lost their potency, because there was a period, half a decade ago or more, where the monthly OPEX was like the biggest deal, and I always thought about this idea that with the increased use of zero DTE and weekly options, whether they're just simply not as important as they've been in the past. Take us through your thoughts in the article.
Yeah, well, I what you said is correct. I mean, I do think monthly expirations have been diminishing in importance. What we've been seeing is a continual compression of the expiration cycle. And what I mean by that is, they used to be the quarterly expirations way back in the dark days, but they would stagger the cycle, so options would settle once a month, would expire once a month, and of course then we got weekly options, roughly 20 years ago, and those have been growing in popularity ever since. And of course, actually, I think it was 2016. I think when they listed Monday and Wednesday expirations on a select list of ETFs and indices, and nobody really paid attention. And by the way, nobody paid attention either when they filled in the expiration cycle on Tuesdays and Thursdays in 2022, because it was a bear market and people weren't speculating. I My thesis is that the coming out party, so as it were, the debutante ball for zero dated options was the February 23 Fed meeting, and how you had disinflation. Powell
Yeah.
kept mentioning disinflation. Market went crazy on Wednesday, kept going crazy on Thursday, but there was an employment number on Friday, and people said, "Oh wait, there's options that I can buy index and ETF options that don't require me to carry the risk over a jobs number. Bring them on." And that's really where it came from.
Yeah.
But um, but every so often, these bigger expirations do rear their heads. Um, they do, and the fact that you saw, if you want any more evidence of that, it was just the fact that they just that SMCI was down 20%, Nvidia was down 10% on nothing other than just you know options expiration sort of metastasizing. It's number one is it's very the one unique feature, and it's very important to remember it is the monthly expirations are when AM index options expire. So
Yes.
coming into it's typical that you get a little extra volatility if there's a number, or even just if there's any news on a monthly expiration Friday, because the AM expiring options are difficult to hedge, because they're cash settled, and so your delta position just vaporizes. It's a good thing, it's
Yeah.
become a feature on the zero dated options that trade in the afternoon, because you basically just, you settle up with money rather than having to carry a position overnight. But if you've been a hedger, if you're long these S&P index options, and you're long calls, and you're sold, you sold index, or you sold the index against it, well, all of a sudden your call evaporates at 9:30 and 9:31, 9:30 in 1 second basically.
Right.
And so you do get a lot of cookie hedging going on, because it accelerates moves um, in advance, and so that sets the tone for the day. So what we saw on Friday was, market kind of it kind of freaked out early. Then, it sort of had its standard rally, because it seems, correct me if I'm wrong, it seems that every morning from about, call it 8:30 Eastern to about 9:30 or 10 o'clock Eastern, the move tends to be up,
Right.
regardless of where we finish the day. But it's sort of, I do think there are people out there going, oh, you know what? It seems to work most mornings. If I buy it at 8:30 and just keep ramping it up, and then it just keeps ramping up. A lot of mornings recently that's been the high, it's the open or
Right.
shortly thereafter. Um, but I think that's what brought it back into play on Friday was, we tried this rally and it failed. And because there was so much expiring gamma, one of the other things to keep in mind is, expiring strikes with high open interest tend to act as either slingshots or magnets. And it
Right.
depends who's long or short the put or the call. Whether if the hedgers tend to be long, meaning speculators sold, and hedgers bought. Well, hedgers tend to buy low, sell high, so that'll sort of pin it a bit. You'll kind of gravitate toward the strike. That's where the magnet
Right.
comes in. If your hedgers are short, and in this speculative environment, that's tended to be more the case. Well, then it tends to be a slingshot, because if you're short options and you're trying to hedge, well, of course, you rather than buy low, sell high, you're sort of sell high,
Yeah.
sort of sell
The
low,
gamma kicks
buy
in.
high.
Yeah.
Yeah. So, and the
The
gamma kicks in the wrong way. So I think it's important, because the difference is, and I've said, another one of my little catchphrases is, that's probably the wrong word, but the one cool thing about monthly expirations is every single option class has zero dated options that day,
right.
if you think about it. So, uh, the zero dated option is not about the option itself, it's about the expiration cycle. And I stumped a room full of options professionals at a conference one time, where, I said, when was it was about, my talk was about zero dated options, me and a couple of others. And I said, when were the first zero dated options? And I got the 2022 and some other, 2016. And I said, 1973,
Yeah.
because
On
it's the,
Fridays.
because every option eventually becomes zero dated. It's just the expiration cycle. So
Yeah.
that's why I do think there is still a point. They're not what they were, for the same reason, like we'd all freak out on the quarterly expirations,
Yeah.
the triple witching. And part of it is the market's just gotten better at dealing with it too. I mean, the more expirations you have, the more used to it you are. But stuff can happen
Yes.
around expirations, and I think that ignoring them, it it doesn't mean something is going to happen. It used to mean something was likely to happen. It doesn't mean something is going to happen, but your odds of something fluky going on tend to rise when you have a monthly or quarterly expiration.
Yeah, I usually assume the magnet will prevail, but knowing that there's all of this gamma out there, that if something triggered it to leave the range, that gamma flip could quickly create that exact event that you're talking about. But it's one of those things where you just need to pay attention. It's an important day, and you have to be just on top of it. Steve, listen, before I let you go, you write some of these great articles. Where can people follow your stuff?
Well, I would love it if you followed me on it's IBKR Campus is our landing page for all the educational stuff at our firm. Traders Insight is the research that we publish, or in my case, the strategy pieces. Um, and so you look for me there. Basically, just search for Steve Sosnick. A lot of my stuff goes up on Twitter at Steve Sosnick. Speaking of
Perfect.
Twitter, happy belated birthday, Patrick.
Oh, thank you
Um,
very much.
and I do post stuff on LinkedIn as well, but not as much over there sometimes. But I would love it if you could subscribe to the daily pieces on IBKR Campus. They're free, and so that would be a great place to start. Really appreciate that one.
All right. Well, thank you, Steve, so much for joining us, and I will certainly have you back again to talk some markets when things start buzzing. So we'll have you back. So thank you very much for joining us, bud.
Looking forward to it again, Patrick. Take care.
Thank you. Well, thank you for tuning into the Market Huddle Plus. We'll be back next week with another episode. Cheers, everyone.